I was going to ask you whether or not you think we are at peak rates, but is the better question is, I don't know, how low do we get in the next cycle?
Well, the one thing I'm confident about is that I don't know. But I think that rates may go a little higher, but not terribly much higher, or not. There's substantial progress being made against inflation, and that's what matters. The economy is producing mixed signals, but at least inflation is well down from the peak, and things are performing well. So I would say that maybe a little higher or maybe not.
You've been known not to give your macro forecast,
right.
Although very recently you've made something similar, which
right.
is
right.
the thesis is that sea change has come,
yes,
and that the next 10 years will be very different.
Very different from the last.
Yeah, and underscore the premise there. And what,
yeah.
what do I do with that information?
Well, if you came into this business since 1980, which covers almost everybody, you've only seen either declining interest rates or ultra low interest rates. You have to go back into the 70s to have seen a different climate, which I fortunately did do. And I believe that this monotonic decline of interest rates is over. Number one, there's not much room for a further decline. And number two, I think the Fed probably understands that it kept rates too low too long, and that there was a negative consequence, certainly in terms of inflation. So, I think the important thing is that, and I said in my memo Sea Change, which was published in December, that I don't believe in forecasts, especially my own, but I'm willing to say that for the next decade, the Fed funds rate is more likely to be between 2 and 4 than between 0 and 2. That's as far as I can go. But and I only say that directionally to indicate my belief that the period of ultra low rates is over.
And let's assume that's correct. Do I have any business then being in the equity market? What does it mean for not so much investment strategies, but where you want to park the bulk of your money, because equities have been rewarded substantially.
Yes.
Over the last 15.
Yes. Look, you as Warren Buffett always says, you don't want to desert the U.S. or the U.S. economy, or I think the corporate sector, and the S&P has given a 10.2% return every year on average for the last century. You don't want to give up that. Right now, it looks like you can get equity-type returns from credit. A little below 10 for what we call liquid credit, stuff that's tradable every day, and well above 10 perhaps for private credit, which is not tradable. The point is that, 21 months ago, today high yield bonds yield in the 9s. 21 months ago, they were in the 4s. When they're in the 9s, you can invest in them with high expectations. Competitive with equities, and more than sufficient to meet most organizations' needs. Private credit returning in the low double digits or more, well, that's obviously very, very competitive. But, equities, what equities have that credit doesn't have is the ability to surprise on the upside.
Right.
And you find some great growing companies in your portfolio. You'll be sorry if you weeded them out.
Although the other side to that is credit is also higher up the capital structure.
Yes.
That's an obligation too. So my question there would be, for longer term investors, let's say they have to match their liabilities for 30 years. Insurance companies come to mind as well.
Yes.
Is the proposition fixed income and not equity markets? Because equities tended to give you longer term returns more consistently.
Right. With variation. But in credit, you can't tie up anything for 30 years. A loan maturity nowadays is 7 years or something like that. So you can invest today and get a rate for 7 years, but then you have no way of knowing today what rate you'll reinvest in 7 years from now. So this is why we don't go 100-0 or 0-100. That's why there will always be a place for equities, but I think now there's a much better place for credit than there has been at most times in the last 14 years.
Would you go above 50%? Would you say majority is apt?
So the question is, the biggest potential catch in becoming a credit investor is that you reduce the likelihood of downside, but you give up the upside of equities. So the question is, how do you and your organization feel about that trade-off? If I say to you, I think I can get you 9 to 10% through a balanced portfolio of credit over the long term, quite dependably. If you say, that's great, I love that, maybe you do 75% of your portfolio.
Okay.
If you say, I want to still make sure that I have exposure to the upside of equities, then you say maybe 50 or 40.
Here's my question, though. This is a relatively new asset class.
Yes.
Or operation, private
Yes.
credit. What happens when we get a recession? I can't think of a recession since this whole began. So
Right.
what happens then?
Well, that's right. I mean, private credit as an asset class really has existed since 2011, and it hasn't been tested by a real recession. We had one bad quarter in 2020 because of an external reason, the pandemic, not internal economic reasons. So, it all it's going to vary because some people do good credit analysis, some people do bad credit analysis. The ones who do good credit analysis perceive the risks accurately and demand a commensurate margin of safety should do quite well. And they may have a default rate of a couple percent a year in their portfolio and lose half their money in those situations. Well, if you have 2% default rate and you lose half your money, you lost 1%. Obviously not a significant number. Bad credit analysts, bad managers will have higher default risks, default rates, and lower recovery. So they could lose several percent, which would make it an unsuccessful strategy.